Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy, and specifically to talk about some very worrying developments in the Chinese car market. Now, if you've been following the channel, you'll know that there has been an explosion of excitement about the Chinese car market over the past 10 years. And this chart shows the number of Chinese car brands dating back to 2014. So back in 2014, which was before electric cars really started to take off. There was some development in electric cars 10 years ago, but it was a very small niche. And in those days, there were around 70 companies in China producing cars. However, as you can see from the shape of this chart, there was a rapid growth up to 2018. And then beyond 2018, we have seen an explosion. And today, it's recorded that there are 169 different car manufacturing companies in China. Now, that is a lot of brands for any market, but to have been developed in such a short space of time really does raise a question as to whether or not these car brands are going to be viable. Because what happens generally when you have a new market developing, such as electric vehicles, is that you get lots of new entrants because people see it as a huge boom, they see it as a growth market. And because the way electric cars are manufactured is totally different from internal combustion engines. In an internal combustion engine, you have a battery that sits somewhere in the engine of the car, and that feeds the electrics, and then you start it up, and obviously it has fuel that comes from the fuel tank, and you have spark plugs and all that sort of thing. In an electric car, it's a little bit like your phone. The battery is spread all across the body of the vehicle. So this meant that traditional manufacturers had to change the way that they were making cars. And this led to lots of new entrants deciding that actually there were better ways to do this, so they were going to start from scratch. So 169 different brands is a lot. And what we're seeing now is intense price competition because the market is still growing, but it's not growing as rapidly as it was in the early days. And so what we've got now is the big players, the really dominant guys in China, are cutting their prices aggressively. And that's causing major problems for a lot of these new entrants. And in fact, it's causing major problems for a lot of the big boys as well. Now, before we go on any further today, I want to talk to you about NordVPN, who I've partnered with for today's video, and who are offering Joe Blogs viewers an exclusive 4 months extra on a 2-year plan. Unfortunately, cybercrime is becoming a more and more common occurrence. And it's not just you and I who are being targeted. It was recently reported that multinational telecommunications giant BT Group had to shut down some of its servers following a ransomware attack by a gang called Black Basta. So it's never been more important to protect yourself online. And NordVPN offers a feature called Threat Protection that blocks access to websites known to host malware, including ransomware. So NordVPN is fantastic for protecting you every time you go online to make sure that nobody's hacking your passwords and can't steal your identity or any money from you. But it's also fantastic for opening up a world of entertainment because you can access movies and TV shows and sports events in areas that's not available to you normally. All you need to do is change your location and access all of that entertainment and information. And the fantastic news is that NordVPN is offering Joe Blogs viewers an exclusive 4 months extra on a 2-year plan, which you can access by going to nordvpn.com/Joe Blogs or clicking in the link in the description below. And the great news is that they're offering a 30-day money-back guarantee. So if we look at what BYD has been doing, which is by far the market leader, it's got a share of around 25% in the Chinese market. And in terms of electric vehicles, it's pretty dominant. And it recently cut the price of its battery-powered Seagull hatchback from around $10,000 to $7,765. That represented a cut in price of over 22%. And $7,800 is very cheap for a brand new electric vehicle. So BYD will be making a very small margin on that. But the problem that that's causing for all of the other manufacturers is that consumers want a good deal, and so they're struggling to actually make any sales. So there is a massive price war going on. But in addition to that, there is now a huge scandal that's emerged in China in terms of what the car manufacturers have been doing to try to achieve sales. And this has been called a zero mileage used car scam, whereby new car manufacturers are selling new cars as if they were second hand, but they don't have any miles on them. So basically, they're brand new cars being sold into the second hand market. And in terms of why this has been done, why would you, as a new car manufacturer, want to sell your vehicle as a used car? Well, the reason for it is because used cars in China don't have any tax applied to them. So if you're a buyer, you don't have to pay any VAT. So that makes it cheaper for consumers. So consumers are still buying the same vehicle, but rather than paying full price, they're getting it at a discount. And this is making it much easier for the car manufacturers to achieve their sales because they're able to sell their cars at a lower price. They're still receiving the full amount that they would have received anyway. It's the government that is losing out because they're not getting their tax. So, what this has led to is dealers and dealerships in China have been dumping vehicles. They've been trying to get rid of as many as possible. And from a buyer's point of view, they're saving 13% on that list price. So if you're thinking about that vehicle that's going to cost $10,000, if you're taking 13% off that, it's only going to cost you $8,700. That is a huge difference for effectively a brand new car. And also, because they're classified as second-hand vehicles, it's got lower registration fees and insurance premiums are lower generally for used cars rather than new cars. Because if the price of the vehicle is 8,700 versus 10,000, the replacement price would only be 8,700. So you're getting a better deal all round. So this is essentially a way that manufacturers in China have been discounting their vehicles. They've basically been knocking the tax off by calling them second-hand cars. And obviously, the Chinese authorities are not very happy about this. And the problem that it represents from the automotive market is that this is an artificial inflation of their sales data. They're showing that they're selling lots of vehicles, but the only reason that they managed to achieve this volume of sales is because they've been avoiding the tax and they've been encouraging the dealers to actually do this on their behalf. So essentially, this is fraudulent from all of the car makers' point of view. They're basically misleading the authorities, telling them that it's a second-hand vehicle, when actually it's brand new. So the authorities are obviously not too happy about this. So there's now a crackdown on this whole side of the market. And this is going to cause a major problem for many of these 169 car brands, because the reason that they've done this is because they weren't hitting their sales targets. They weren't able to achieve the volumes that they wanted to. So going through a fake registration process and encouraging the dealers to manipulate the sales and sell it as a second-hand vehicle has been a way of boosting short-term sales, but they weren't going to get away with that forever. And the problem is that now that it's being clamped down upon, it's causing major problems because consumers are now wary about buying new cars. Because if you've bought a new car, if you paid that $10,000, if you're one of the people who happily said, yes, I'll buy it brand new, and then your friend bought exactly the same vehicle for 8,700 with 0 miles on it, you'd feel a bit cheated by the new car company. And the fact that this has now been exposed, there's a loss of confidence in those manufacturers because nobody wants to buy a new car from somebody that they think that they can buy a virtually new car from for a much lower price. So this has damaged the integrity of the market, but nobody now wants to sign up for new cars. So this has actually caused the car makers a long-term problem. And it's a little bit like what's been going on in the property sector, whereby we saw a complete loss of confidence. We saw that boom and we saw lots of property developers entering the market. And there was that happy days when everybody was signing up and handing over their life savings for apartments that haven't even been built yet. But now there is a complete loss of confidence because the market started to come back down. Nobody wanted to sign up to those new deals anymore. And there's now a flood of second-hand apartments coming onto the market. So there are some really big comparables here between what's happening in the car sector and what happened in the property sector. And if you follow the channel, you'll know that the property sector has been in the toilet for the last 3 or 4 years in China. Now, in terms of who the big boys are in China, this is the list of the top 10 manufacturers. Interested to see how many of these you're familiar with. BYD is becoming one of the biggest brands globally. It's actually overtaken Tesla in terms of the volume of electric cars sold. That's hybrid and battery electric. And in 2024 in China, in the first half, it sold 1.6 million units. The second biggest manufacturer officially is Volkswagen. It's a joint venture owned by a Chinese business. So it's not Volkswagen just exporting to China. That's actually a homegrown company that owns the Volkswagen brand. Chery is the third biggest, followed by Geely, Changan, FAW Volkswagen, Great Wall Motor. Tesla comes in at number 8 as the only overseas manufacturer. The overseas brand, it's manufacturing in China. SAIC, GM, and Dongfeng Motor are the top 10. The reason why I wanted to show you this top 10 was to highlight the Great Wall Motors, which you may not be familiar with, but as you can see, they're selling around 1 million vehicles a year in China. And the chairman of Great Wall recently stated that he believes that there is an Evergrande of the auto industry that already exists. It just hasn't collapsed yet. So basically, what he's saying is that many of the car companies in China are over leveraged. They've taken on too much debt, and they're now at risk of going bust, of just collapsing because they built up all of this debt. And if the car market now starts to turn the corner and go back down, and these companies can't actually make any profit and therefore can't service the debt, then they'll be in exactly the same situation as Evergrande was. And if you remember, way back when I first started this channel, I was talking about Evergrande a lot. And at that time, that company had $300 billion worth of debt. It was the most indebted company in the whole of the world. Now, unfortunately, we all know the sorry tale. It lost sales, it lost all of its volume, and then basically it was liquidated. So it no longer exists as an entity. And the Great Wall chairman is saying that he believes that the car industry is going the same way as the property industry. There are too many suppliers, the demand is now coming off, and we've got this loss of confidence in terms of new purchasers. And the price wars are also killing a lot of these companies because very few of them are actually making a profit. Now, if we have a look at this metric, you can see that of the 169 car manufacturers in China, it's estimated that maybe over 100 of those are making losses at the moment. And actually, the situation is getting worse. With every price cut that BYD announces, that's killing more of these companies because they're having to compete on price in order to achieve the sales. And as BYD cuts it further and further, that's taking more and more of them into a loss-making situation. And it's estimated that of the 169 companies, maybe only 10 of them are turning a profit at the moment. And those profits are shrinking because of this price war. So the notable brands that are estimated to be making a profit are BYD, Geely, Chery, Li Auto, and Leap Motor. So they're some of the biggest brands. We just had a look at the top 10. And then we've got lots and lots of loss-making brands. And an interesting one here is Zeekr, which recently listed its shares in the USA. And we've seen that story before of Chinese companies listing shares in the USA before they've made a profit. And it'll be interesting to see whether or not Zeekr survives because it doesn't have a lot of overseas presence at the moment. It's mostly dependent on the Chinese market. And if we have a look at this slide, it shows the volume of debt and liabilities that the big companies in China have built up. So I wanted to show this really to compare it to that Evergrande situation, because Evergrande had $300 billion worth of debt. That is a huge amount of debt. Well, BYD, the biggest car company, is estimated to have $125 billion worth of debt. That is a lot of debt. That is a huge amount. That's bigger than most companies in the West have. And that's a combination of actual debt and supplier credit. But the actual physical debt is over half of that figure. So that's a problem, because what that means is it's obviously you need to service that debt, you need to pay the interest and also some repayments at some point. And if we've got this price war continuing where profits are going to be shrinking for BYD, that's going to represent a significant challenge. SAIC, which is nowhere near as big as BYD, has $118 billion worth of debt. Geely, 95 billion. And then we've got a variety of other companies that have billions of dollars of debt. And $1 billion is a lot of debt for any company, particularly if you're loss making. So NIO, as we just talked about, is loss making. So how do you service $1 billion worth of debt if you're not making any profit? Well, the answer to that is you can't. It's impossible. Obviously, the plan is for NIO and all of these other hundreds of other companies to become profitable, but that's going to be virtually impossible in a market where you've got fierce price competition and it's starting to slow down in terms of growth. So what we're going to see is that lots of these companies are going to become bankrupt. They will become illiquid. Once they run out of finance that's being provided by the banks or their investors, then it will be game over for these companies. It's simply not possible for them to survive with that level of debt. Now, in terms of what might happen to the Chinese economy, I thought it was worth having a look at this slide, which shows the number of people employed in the automotive sector in China. And we've got just under 5 million people who are directly employed by the manufacturers. So these are these 169 companies that are making cars. In addition to that, there's around about 500,000 employed by wholesalers. So these are businesses that are moving cars and doing deals in China. The suppliers who are supplying various components and parts to the manufacturers, around about 3 million people employed in that side of the business. And then over 1 million people are employed in car dealerships who are selling those cars to the Chinese population. So there's around about 10 million people currently employed in the automotive sector in China. And obviously, if it's going to be sustainable, if you're going to keep those people in employment, you need all of these businesses to carry on existing. But if we're likely to see a lot of these companies going bust, the competition in price and also the shakeout in the industry, there is no way there is going to be 169 companies this time next year. Because if you look at the USA, there's around about 60 companies, and the USA is the second biggest market. It's not as big as China, but also they're making more profit because the prices are higher. So cars can actually be sold at a profit, whereas in China, they're being sold at a loss. So these 10 million people, their jobs will be at risk if these 169 companies do start going bust. So what's the summary and conclusion today? Well, I wanted to post this video because I think it's interesting what's going on in the car market in China, because what we are seeing here is almost a carbon copy repeat of what happened in the property sector. If you follow the channel, you'll be aware that at the start of this century, they changed the rules in China in terms of property ownership, and that led to an explosion in demand. And we saw all these property development companies entering the market. They were buying land all over China. They were building as many apartments as they could, and people couldn't get enough of it. Everybody was queuing around the block to buy these apartments, and the price went up and everything went really well for a while. And then all of a sudden, the Chinese authorities realized that these property development companies had taken on far too much debt and that there was no way that they were ever going to be able to pay it back or to be able to turn a profit. And we saw a whole series of those companies becoming bankrupt and illiquid and defaulting on their debt. And Evergrande was probably the most famous example out of all of those businesses. And what we're seeing in the car market is a very similar scenario. So 10 years ago, there were around 70 companies. Today, there's more than 169 companies, and they've grown rapidly over the past 4 or 5 years as the market started to expand and electric vehicles became the next big thing. Lots of new companies wanted to get on board. They've raised investment, they've raised debt in China and overseas in terms of trying to target this market. So we've had all of these startup entrants piling into the market, developing their shiny cars and lovely adverts and lots of glossy imagery. But what we're now seeing is that there is too many cars and not enough demand. So we've got fierce competition for the consumers. And the consumers in China have been seeing prices coming down and down and down over the past few years. And BYD has taken a dominant market position. It's got around about 25% of the market. And it's now trying to fight off the competition by cutting its prices continually. And we saw earlier that just around a month ago, BYD cut the price of one of its leading vehicles by 22% to around $7,800. That is very cheap for a brand new car. And the new entrants simply can't compete with that. They don't have the scale of BYD and they don't have any profits to be able to absorb this discounting marketing idea. And the reason why BYD is doing this is because, firstly, it wants to keep growing its volume of sales. And secondly, it knows that if it can get rid of a lot of the competition, then there will be more profits to come down the road, because that's the classic tactic when you've got an overheated market where there are too many suppliers. You basically cut your prices until everybody else goes bankrupt. And then once you're left as the only player in town, you can then start increasing your prices again because people don't really have any choice. And that's what's happening in the Chinese market at the moment. But the problem that this represents to the Chinese economy is that lots and lots of these companies have taken on huge amounts of debt. We saw earlier that they have tens and in some cases hundreds of billions of dollars of debt built up. So if those companies go bust, then obviously they're going to have to release all of their employees, so everybody gets made redundant. But also they're going to default on their debt, so they won't have anything to pay back in terms of there'll be no recovery on those businesses. There's really no assets. There's nothing that you would have to be able to turn into cash to pay yourself back. So the banks are going to have to write off all of their debt, but also all of the investors who've put money into these new startups are also going to see all of their investment wiped out. So there's going to be a complete reduction in terms of capital that's gone into this industry. But we'll also see lots of people being made redundant. That's going to cause problems in terms of if you lose your job, obviously you have less money, you have worries in terms of cash, so you're likely to spend less. And this is coming at a time when prices have been falling for the past 3 months in China. We've seen deflation, so prices going down in every one of the last 3 months. And the car companies are partly responsible for this because they're cutting their prices. We talked about BYD cutting 22% off its price. Obviously, if everybody did that, you would have minus 22% deflation in China. So this is one of the root causes of the deflation, the big price competition that's going on. So that's bad news for the economy in general. But specifically talking about the car sector, it looks like it's in danger of collapsing because lots of these businesses are going to start going bust. They simply can't survive if they're not making sales and not making profit when you've got huge amounts of debt. The only way that they could survive is if they were given more debt. But that's what happened with the property development companies. They got to the point where they ran out of cash, and so they were given more and more and more debt to keep funding all of their growth. And at some point, somebody has to say, enough's enough, let's stop this, and then that company goes bust. And that's what's happening in the Chinese car market at the moment. So the overall summary of today's video is that we are seeing fierce competition in the Chinese car market. We've seen an explosion in terms of the number of suppliers. That isn't sustainable. And on top of that, we've seen this new market practice of selling second-hand cars with 0 miles on them. So basically, new cars are being sold into the second-hand market to try to avoid paying any tax to give a better deal to consumers. The Chinese authorities have awoken to that now. They've banned this practice. That's going to cut off the route to market for many of these businesses. And over the course of the next 6 to 12 months, it's very likely that we will see lots of car companies in China going bust unless the Chinese authorities allow them to take on more and more debt. And all that will do is kick the can down the road and delay the inevitable. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and thank you so much to everyone that supported me. If you bought me a coffee or sent me a YouTube super thanks, really appreciate that. And if you're a long-term supporter, either through Patreon or YouTube membership or Buy Me a Coffee membership, thank you, really keeps me motivated. And here's something to put a smile on your face.